Hello everyone, welcome back. If you're holding physical silver right now, keep listening, because what I'm about to walk you through is the kind of setup that makes paper markets sweat. We're going to talk about why registered inventory at the main exchange is shrinking, why delivery demand is exploding in a month that's not even supposed to be busy, and why the price you see on a screen may be the least important number in the room. And yes, I know it sounds intense. That's because the situation is intense. The last few months in silver have not been normal price discovery. They've been a tug of war between people who want the metal and people who want the appearance of control. Now, real quick, if you get value from this kind of breakdown, support the campaign we're running to push back against copycat channels that recycle other people's work. Hit subscribe, and in the comments write, "Our John AG." That one line helps more than you think. Also, check the description after this video. I've left bonus links there for you, including a premium WhatsApp channel link and an option to join channel membership. If you want the deeper research and the faster updates, that's where it lives. All right, here's the big picture. For years, silver has been treated like a side character in the global money story. The world talks about tech, about stocks, about real estate, about flashy trends. Meanwhile, the metal that quietly runs through electronics, energy systems, medical tools, and industrial supply chains has been traded like a casino chip. More promises than product, more contracts than metal, more noise than truth. And that worked, until it didn't. Because when enough buyers want the real thing, bars, coins, physical metal in hand, the system has to prove it can deliver. And that's where today's story gets uncomfortable. In this video, I'm going to make sense of what's happening right now by giving you a full update on three things: the paper activity, the delivery activity, and the warehouse reality. Then I'm going to connect it to the macro environment, because silver doesn't move in isolation. It moves inside a world where confidence is being tested everywhere, all at once. And near the end, I'm going to ask you two questions that I genuinely want your answers to, because your on-the-ground experience, premiums, availability, local shortages, often tells the truth before the charts do. Now, let's start with a simple line that sounds dramatic, but it's actually a fair summary of what physical buyers are saying right now. Pay me my silver. Not later, not in a different form, not with a cash settlement and a smile. The message is, deliver the metal. That's not emotion. That's market psychology shifting. Because a normal commodity market runs on trust. It runs on the assumption that when you buy a contract and stand for delivery, the system can hand you the goods. And most of the time it can, because most participants never demand delivery. They trade for exposure, not for possession. They want price action, not pallets. But when the ratio of paper to physical gets extreme, and when the world gets unstable, and when people stop trusting promises, the same market structure that looked efficient starts to look fragile. So let's talk about what we're seeing on the tape. We saw silver push above the mid-90s, and then we saw a fast smash down. And I want you to notice something. The speed of those moves tells you you're not watching a purely organic market. You're watching a market where positioning, leverage, and forced behavior can move price more aggressively than simple supply and demand, at least for a while. And that leads to the question, if price isn't the cleanest signal, what is? Volume, delivery, inventory movement, spreads between regions. Those are the fingerprints. Let's talk volume first, because the volume is screaming. There were sessions recently where the number of contracts traded was staggering. Think about it this way. The total open interest, the total number of outstanding contracts held by everyone, was roughly in the high 100,000 range. Yet on some days, the volume printed well above 200,000 contracts. One day alone was around 250,000 contracts. That matters because it means the same claims were getting flipped multiple times in a single day. Not 1 billion physical ounces moving in trucks, 1 billion paper ounces changing hands in keystrokes. And to be clear, futures markets exist for hedging. Producers hedge, consumers hedge, liquidity matters. I'm not anti-futures, I'm anti-confusion. Because when the paper activity becomes its own universe, detached from physical, it creates a situation where the chart can lie to you, while the warehouses tell a different story. Now, let's talk deliveries, because this is where the story gets spicy. Here's what's unusual. We're seeing heavy delivery demand in a month that isn't typically a major delivery month. That matters because it suggests participants aren't waiting for the scheduled moments. They're pushing now. And when you look at the delivered ounces for the month, we're approaching record territory. Something in the neighborhood of 40+ million ounces delivered in a month that normally wouldn't be setting records. Let that sink in. That's not a small footnote. That's the kind of number that changes how market insiders think, because it forces one question. Where is the metal coming from? Now, in the delivery reports, you can often see which large institutions are issuing and which are stopping. In plain English, who is providing metal and who is taking it. And what stands out is that a few familiar names keep showing up, not because they are villains in a movie, but because they are gigantic. When you're that big, you're involved in everything. You provide, you take, you hedge, you offset, you shuffle. We saw a notable delivery chunk, around 2.7 million ounces, where one major bank was the issuer, and a large customer on the other side of a different major bank was the stopper. The point isn't the logo, the point is the flow. Because when big customers are standing for delivery and issuers are having to source metal to meet that demand, it tightens the physical system. Now, let's go deeper into the warehouse categories, because this is the part that many people misunderstand. The exchange warehouse reports typically split inventory into eligible and registered. Eligible means the metal meets the specs and is stored in approved warehouses, but it is not necessarily available for delivery against a contract. It might be someone's private metal, sitting there, not for sale. Registered means the metal is specifically tagged as available for delivery. If you remember nothing else today, remember this. Registered is the fuel tank for delivery. Eligible is the parking lot. And you can't assume the cars in the parking lot are willing to drive. So when registered inventory drops sharply, it doesn't just mean silver moved. It means the deliverable pool is shrinking. Now zoom out. Over the last several months, registered inventory has fallen hard. We're talking about a drop from roughly the high 100s of millions of ounces down into the low 100s. In one stretch, it looked like the registered category slid from around 200 million ounces toward roughly 120 million ounces. And when people see that, they ask, so what? There's still 120 million. But here's the catch. Not all ounces are equal. A large portion of warehouse metal can be tied up in arrangements, claims, and structures that make it less free than the headline suggests. Some inventory appears connected to big pooled products that may not behave like loose metal. So while I'm not telling you an exact number, I'm telling you the logic. If a big chunk of what's registered isn't realistically available, then the effective supply for delivery is tighter than advertised. And here's the part that should make you sit up. The inflows haven't been impressive. Look at the pattern. You don't see a wave of new metal rushing into registered. You see persistent outflows. Week after week, month after month, more coming out than going in. It's like watching a store shelf get emptier while the manager keeps saying, don't worry, we've got plenty in the back. Okay, show me. Now, I want to run a simple stress test. This is not a prophecy. It's a way to understand the slope. If the registered category keeps draining at anything like the pace we've seen recently, you can sketch a timeline where inventory levels hit uncomfortable thresholds within months, not years. And once it gets uncomfortable, the market has choices, and none of them are clean. Option 1. The price rises enough to attract metal out of hiding. People decide the offer is good enough, and they sell. Option 2. Metal gets reclassified from eligible to registered. But that requires willingness. That requires someone to put their metal on the line. Option 3. The system uses procedural tools, delays, incentives, or alternative settlement to relieve pressure without forcing the price to do the honest work. And here's the thing. If option 3 becomes the go-to solution, confidence takes damage. Because a delivery market that doesn't deliver is not a delivery market. It's a betting app with extra paperwork. Now, let's bring in the international signal that a lot of people ignore, the premium in Asia. When you see a persistent price difference between the Western exchange price and the price in major Asian hubs, it's a clue about localized demand, supply constraints, and logistics. Recently, the implied price in a major Asian market was around $100 plus, while the Western benchmark was notably lower. That's a big gap. Sometimes that gap reflects shipping costs, form factors, taxes, or local premiums. Sometimes it reflects something simpler. Physical is tight where demand is concentrated. And when that gap stays wide, it becomes an invitation. Move metal from where it's cheaper to where it's more expensive. But here's the catch. You can't arbitrage paper. You need physical. You need the right bars. You need the right standards. You need relationships and logistics, and you need time. So the fact that the gap exists doesn't automatically mean easy money. Sometimes it means tight metal, and tight metal is what forces change. Now, I also want to highlight something most people miss: import behavior. We've seen major importing nations take in enormous amounts of silver, hundreds of millions of ounces in a year, because silver is not just an investment metal for them. It's culture, it's savings, it's industry, it's jewelry, it's small denomination wealth. When one country alone imports around 200 million ounces in a year, that's not a casual purchase. That's a structural demand pipeline. At the same time, if large producing regions restrict exports or tighten rules, it can amplify scarcity outside their borders. Even rumors of export limits can change behavior, because companies and countries don't wait for confirmation when supply chains are on the line. Now, pause here because this is where the story can become very viral, and it's also where people make mistakes. Some will hear tight supply and chase mining shares. I need you to separate metal from miners. Mining shares are businesses. They have political risk. They have operational risk. They have energy cost risk. They have management risk. And in a world where governments discuss resource nationalism, higher taxes, export limits, and strategic stockpiles, mining shares can become a policy target. Physical metal in your own possession is different. It's not a promise. It's not a management team. It's not a permit. It's a tangible asset. And I'm going to say something blunt. In unstable times, simplicity wins. Now, before we go deeper, let me do a quick creative detour because I promised I'd integrate this naturally. If you want silver-related success stories, real people, real journeys, how they built positions and protected their savings, there's a link in the description to another channel focused on that. Subscribe over there too and see how everyday people made it work. And speaking of real wins, if you're one of the people who has already made progress, paid off debt, built savings, stacked metal, started investing, share a quick win in the comments. Your success story might be the push someone else needs today. All right, back to the exchange players. Every delivery period, you'll see a few institutions pop up repeatedly. Some months they take delivery, other months they deliver. And if you only look at 1 month, you might think, they're fine. But when you watch the pattern, month to month, you can see behaviors that look like juggling. It's not about drama, it's about mechanics. For example, one large institution might take a significant amount of metal 1 month, then deliver a significant amount the next month. That pattern can suggest they're managing obligations, owing metal, then sourcing metal, then fulfilling metal, then rolling again. And when multiple big institutions are doing that at the same time, it tells you the market is being managed actively, because the natural flow of metal isn't enough to keep everything smooth. Now, I'm not making legal accusations. I'm describing how large books get managed in real markets. Obligations, hedges, leases, offsets, and timing problems. Timing problems matter because if too many obligations come due at once, you can't solve that with a press release. You solve it with metal, or you solve it with rule changes. Now, here's the retention point. The most important part of this story isn't even the registered number. It's what happens when confidence shifts. Commodities don't just move on supply and demand. They move on trust. If people believe the market is stable, they trade paper happily. If people believe the world is stable, they hold cash happily. If people believe institutions are stable, they keep money in accounts happily. But if that belief cracks, if enough people decide, I want the real thing in my possession, then the system's weakest link gets tested. And silver has a habit of being that weak link. Because the physical market is smaller than most people assume, the industrial demand is real, and the above-ground stockpiles aren't infinite. Now, I want to widen the lens, because there's a macro overlay here that you can't ignore. We are in an environment where governments are more willing to use tariffs, export controls, and sanctions. We are in an environment where geopolitical headlines can shift supply chains overnight. We are in an environment where debt levels are massive and central banks can't pretend rates are normal forever. When the macro system is fragile, hard assets get repriced. Not because everyone suddenly loves metal, but because the alternative starts to look worse. And here's the twist. In that kind of environment, volatility is not a sign that the thesis is wrong. Volatility is the price of admission. You might see silver spike, then get smashed. Spike, then get smashed. And that pattern doesn't necessarily mean it's over. It can mean it's being defended. Now, I'm going to say something that will upset some people. The mainstream financial commentary often picks the wrong timing on purpose. They will tell you to buy what's already popular, and they will tell you to sell what's about to become scarce. They'll call silver a bubble right as the physical market tightens. They'll call it a mania right before a structural shortage reveals itself. And why does that happen? Because fear is a tool. If you can scare normal people out, you reduce pressure. You keep the system smoother for the insiders. So I want you to be careful when fear aligns perfectly with a moment of physical tightness. That's when psychological tactics work best. Now, let's ground this with a practical mindset. I'm not telling you to sell everything and buy metal. I'm not telling you to leverage. I'm not telling you to gamble. I'm telling you to build a position you can hold through noise. Because the people who lose in silver are usually not the people who were wrong. They're the people who were forced out by volatility. Now let's talk about custody, because this is where I get serious. If you own physical, the whole point is possession. If your metal is stored in a place you can't access, with rules you didn't write, under a system that can be changed, then you don't own metal, you own a claim. And claims can be delayed. Claims can be negotiated. Claims can be cash settled. So whatever you choose to do, think about your personal risk. Think about your jurisdiction. Think about your access. Think about what ownership really means. Now let's connect this to the bigger financial system risk, because the silver story is a chapter in a larger book. In a world built on derivatives, promises stacked on promises, contagion risk is real. If one major institution fails, the ripples don't stop at that institution. They run through counterparties, clearing systems, and confidence. And you might be thinking, my bank is small, I'm safe. Maybe. But bank runs don't care about logic. They care about fear. And fear spreads faster than facts. So the argument for holding some assets outside the system isn't paranoia. It's diversification across structures. It's acknowledging that digital balances are claims, and claims can be frozen, delayed, or reinterpreted during stress. And if you think that can't happen, remember, every crisis creates temporary measures. Temporary measures have a habit of becoming permanent. Now, I want to drop a controlled cliffhanger right here because I want you to stay to the end. If the registered category keeps draining, and if delivery appetite stays elevated, the market eventually faces a moment where either price must rise to attract metal, or the rules must change to avoid admitting the shortage. And both outcomes are bullish for one thing: holding physical. Now you're probably wondering, so when does it break? I'm not going to give you a magic date. Anyone who gives you a magic date is selling certainty they don't have. But I will tell you what to watch. Watch the registered inventory trend. Watch whether new metal shows up. Watch whether delivery demands stay elevated. Watch whether spreads between regions widen. Watch whether retail premiums remain stubborn. And watch something else that doesn't get enough attention: the tone of messaging. When the narrative shifts from silver is boring to silver is risky to silver is manipulated to silver is a bubble to silver will crash, that's often the emotional toolkit used to scare people out right before the next leg higher. Now, I'm not saying every warning is false. Markets do correct. Volatility is real. But I am saying treat coordinated fear with skepticism when the physical market is sending the opposite signal. Now let's address the elephant in the room: the registered inventory running out headline. Could the exchange find metal? Yes. Could metal be moved in? Yes. Could classifications change? Yes. But here's the problem. Every time you need emergency measures, you prove the system is tighter than advertised. And that's why this matters. The mainstream narrative treats silver like a trade, but the real story is silver as a stress test of the credibility of paper claims. Because if a market that is supposed to deliver starts struggling to deliver, people start asking uncomfortable questions about every other market built on leverage. Now, I'm going to keep it honest. This is not a guarantee of immediate riches. It's a thesis about asymmetry. The downside of holding some physical silver, if you size it responsibly, is limited by time and patience. The upside in a re-rating event can be explosive. That's the kind of setup that shows up rarely. Now, I want to bring you into the conversation, because I'm not here to talk at you. I want to know what you're seeing. Question 1. Have you noticed higher premiums or lower availability in your local market when you try to buy physical silver? Question 2. Do you think the next major move comes from a price spike or from a change in the rules? And why? Drop your answers below. And again, if you've got a personal win story, maybe you started stacking, maybe you paid off debt, maybe you built a side income, share it in the comments. It keeps people motivated, especially during noisy markets. Now, I want to circle back to something that's easy to overlook: why the paper market fights so hard. Think about incentives. Every ounce of physical metal that moves into private hands is an ounce that cannot be rehypothecated easily. It cannot be lent repeatedly. It cannot be used as a cheap input for endless paper claims. Physical in hand is a constraint. So when the system feels tight, the natural response is to manage demand. You manage demand with narrative, you manage demand with volatility, you manage demand with discouragement. That's why you will see smashdowns on strong volume. That's why you will see headlines that sound like warnings. That's why you will see people suddenly concerned for your safety right when you're about to do something that reduces their control. Now, I'm going to give you a mental model that helps. Imagine two markets running at the same time. One market is paper. It's huge, it's fast, it's liquid, it's dominated by institutions and leverage. The other market is physical. It's smaller, it's slower, it's constrained by logistics. It's dominated by real users and long-term holders. Price is set mainly by the paper market until the physical market refuses to cooperate. When physical refuses to cooperate, paper has to adjust. And that's where we're heading, in my view, because the warehouse trend is not random. Now let me add one more layer that connects the warehouse story to the way people actually behave in real life. When the world feels calm, people chase yield. They park money in whatever pays interest. They buy whatever the media celebrates. They assume liquidity will always be there. But when the world feels unstable, priorities flip. People stop asking what returns the most and start asking what survives the most. That is why physical metals become a conversation in the first place. And silver is the awkward one because it's not just a store of value story, it's a utility metal. That means there are two demand engines: investors who want insurance and industries that need supply. When both engines push at the same time and the deliverable pool is shrinking, you don't need a miracle for the market to tighten. You just need normal behavior. Now, I want to address a hot topic you've probably seen in comments: the gold to silver ratio. At times, that ratio sits around 50 to 1, 60 to 1, even higher. Some people look at that and say, silver must be undervalued, because historically the ratio has moved lower during major precious metal cycles. Others go further and claim we could even see an extreme squeeze where silver briefly outruns gold by a shocking margin. Here's my take. Ratios can guide you, but they should not hypnotize you. The ratio is not a law of nature. It's a reflection of market preference, liquidity, and trust at a given moment. That said, when silver goes from ignored to necessary, the ratio can move fast. And it tends to move in bursts, not in a smooth line. That's why people get chopped up trying to trade it. They buy late, they sell early, and they miss the part that changes lives. If you're building a long-term position, think in phases. Accumulation is boring. The breakout is violent. The repricing is chaotic. And the peak is emotional. If you understand those phases, you're harder to manipulate. Now, I also received two common viewer-style questions this week, so I want to answer them in the flow of what we've already covered. The first question is basically, if the exchange is draining, why can price still get slammed? Great question, and the answer is simple. Paper can move price in the short run because it's where the marginal price is set. Large leveraged sellers can overwhelm short-term buying, trigger stops, force liquidations, and create a cascade. That can happen even if the physical market is tight, because physical buyers don't react the same way. They don't sell because the candle went red. They buy because they need metal, or because they have a thesis and patience. So a price slam doesn't disprove tightness. Sometimes it's the mechanism used to manage tightness by scaring off new demand. The second question is, if Asia is paying more, why doesn't metal flood from west to east? Sometimes it does, but there are bottlenecks. Bar specs, refinery capacity, shipping lanes, insurance, financing, and, this part matters, availability. It's easy to say, just arbitrage it, until you actually try to source large quantities of the right physical product without blowing out premiums, without waiting months, and without taking counterparty risk. And if you're wondering why this matters for you, it matters because it reveals where the stress is, not in screenshots, but in logistics. Now let's talk about the political and policy angle without turning this into a drama channel. Across the globe, more countries are looking at their natural resources and asking, why are we letting foreigners extract this and keep most of the benefit? That can lead to higher taxes, stricter regulations, export limits, or even nationalization pressure. Whether you agree with it or not, it's a real risk for mining operations. And that's why, again, miners are not the same as metal. This is also why people who think they're diversified because they own mining ETFs can get surprised. If policy changes, the stock can suffer even if the metal rises. The metal doesn't have a board meeting. The metal doesn't need permits renewed. The metal doesn't face a surprise tax hike. Now, there's another point that people don't talk about enough. In a stressed environment, governments don't just target mines. They can target storage and large pooled hoards because it's visible, centralized, and politically convenient. That's one reason many stackers prefer personal custody or diversified storage choices. Again, not fear, just structure. Now, I'm going to lay out a scenario that I want you to keep in the back of your mind. Imagine the registered inventory keeps draining. Imagine delivery demand stays elevated. Imagine retail premiums stay stubborn. Imagine regional price spreads stay wide. At some point, a headline hits that changes psychology. It could be a policy announcement. It could be a supply disruption. It could be a major entity choosing delivery instead of cash. It could be an industry buyer announcing a long-term procurement problem. And when that happens, the scramble begins. Not a slow drift, a scramble. Because the first move is always disbelief, then denial, then it's a temporary glitch, then panic. The scramble phase is where most viewers will show up. They will ask, is it too late? They will want certainty. They will want a perfect entry. But the perfect entry was the boring months when nobody cared. So if you're watching this now, you're ahead of the crowd. Your job is not to predict the day. Your job is to make sure you're not forced to act under pressure. Now, quick reminder, none of this is financial advice. It's education and commentary. You decide what fits your life. And one more thing. If you're watching regularly but you're not subscribed, fix that. Subscribe in one tap because it tells the algorithm to stop feeding you recycled noise and start feeding you signal. And if you want those deeper, members-only breakdowns with extra charts and a research team, the membership link is waiting in the description. Don't just watch the story unfold, position calmly, and tell me what you're stacking right now, in ounces, if you can. Now, I also want to address a wild topic that pops up in every hard asset cycle: hidden supplies, secret discoveries, rumors of giant deposits. You will hear stories online about massive underground stashes and secret caches. You will hear claims about extraordinary discoveries. Some of it is nonsense, some of it is misinterpreted, and some of it is simply unverified. My advice is simple. Don't build your financial plan on rumors. Build your plan on what we can observe: inventories, flows, premiums, and demand. Rumors can be entertaining, but evidence is what protects you. Now, let's talk about what you can do with this information without turning it into a gamble. First, decide your role. Are you a trader, an investor, a saver, a hedger? If you're a trader, you're playing the paper game and you need risk controls. If you're a saver, you want durability and simplicity, and physical is a different tool. If you're hedging, you want balance, some exposure that benefits when trust declines without destroying your life if volatility hits. Second, decide your time horizon. Silver can move violently. If you can't hold through turbulence, size it smaller. Third, decide your custody. Possession matters. And fourth, decide your information sources. The world is loud. Choose signals over noise. Now, before I wrap this up, I want to give one more reminder about membership, because many of you ask for more detail than we can fit in a public video. We are offering members-only videos where a separate research team goes deeper. More data, more cross-checking, more charts, more context. Content we don't always publish publicly. If you want that layer, check the membership link in the description. And again, the description has bonus links: the premium WhatsApp channel, the membership option, and other resources you can explore. Now, as we close, I want to bring it back to a principle that gets lost in the noise. It's not about predicting every tick. It's about understanding the structure you're participating in. Paper markets can set the headline price, but physical markets set the floor in the long run. And when physical gets tight, the paper market has two options: price it properly or manage the appearance. Either way, the person holding real metal has leverage. So here's my simple call to action. Subscribe. It takes 1 second. And if you want to support the work and the anti-copycat push, comment "Our John AG" below. If you enjoyed this breakdown, share it with someone who still thinks silver is just a speculation. They might need to hear this message before the next move makes headlines. Stay sharp, keep your position sane, and remember, in a world full of promises, possession is a strategy. I'll see you in the next one.